to the then Minister of Trade, Kanimba. We were working together in Minicom between 2015 and 2017, trying to promote private sector development, trying to create more jobs and exports in Rwanda. But of course, it always comes back to access to finance. And that's then what led me in 2017 to leave working with the government to start BeneFactors as a way of addressing this gap, that we can see the market and provide services to firms that we were working with, and be part of developing this beautiful country.
Yeah. Thank you, Olivia. And I think one thing to pick up from what you're saying is the ecosystem has some financing gaps in Rwanda. And, you know, a lot of the companies turn to either venture capital, or if they're really grown, they will think of, you know, a private equity player. And usually all these firms have different, you know, motives, but one key catching theme they usually will have is you have to grow and scale. And there's always that grow or die paradigm. And the issue with that is the company is put on, you know, unnecessary pressure sometimes to be able to achieve certain milestones. And yet the reality, as we know, is quite different, you know, in Rwanda and Africa generally. So on the other spectrum as well, one thing to consider is there's always that race to seek, you know, validation from investors through doing successive rounds. So the startup actually fails to, you know, concentrate on what really matters, to be able to build its idea and then, you know, grow from there. So against that backdrop, I'd like us to, you know, reflect on this and go through these questions that I might have for you. Firstly, you've talked about BeneFactors. Could you just tell us how BeneFactors works, and, you know, the whole factoring process, how that looks like?
Yep, happily. So factoring is an old product, actually. It's been around for millennia. We've seen sort of the earliest history of factoring as a financial service to small and growing businesses go back to pre-Christ era, where we're in the ancient Middle Eastern cultures of Mesopotamia. It is a mechanism where simply saying that someone owes you money, you don't want to wait for them to pay you back. Maybe they have 30 days to pay you, so you would like someone else to take over that debt from you. And that's in a sense what factoring is. It's when two companies have some sort of commercial relationship with each other. One has delivered a service or goods. There's an invoice that has been accepted. The goods have been consumed. And then between these two companies, they've agreed that the buyer can wait a certain amount of time before they pay. And that can be set by many different things. Typically, we see that the more unequal the dynamics, the sizes are between these two companies, the longer the wait is. So we'll often see that if it's a small supplier selling to a large company, they're completely at the benefit of whenever this large company feels like paying. And that can be tough for a small business. You've delivered something, you have to pay salaries, you have to pay taxes, you want to get started on the next order, maybe you can't wait 3 months before you get paid. And that's where a factor can come in and say, okay, well, this large company, let's say it can be Soras, the insurance company in Rwanda, right? So if it's a large known reputable buyer, one can sort of assume that they will pay their invoices. They might take some time, but they will pay. But if you're a small supplier, you would like to get paid today, then you will say to a third party, which is a factor, which is us, to say, you know what, can you take over this invoice for me? If you pay me today, I will accept to get maybe 95% of the value of the invoice, as long as I can get the money today and not wait 3 months. And then us as a factor will then take over the waiting period. And that's in a nutshell what we do. We provide the short-term liquidity by removing the need to wait to get paid. But of course, there's a fee involved. Some companies say, okay, well, actually, we don't mind. We can wait 2 months. But if you're a small company, especially if you're a growing company as well, you want to add more buyers, you don't want to wait 2-3 months, you want to have that cash in your bank account today, then factoring can be a very good solution.
Okay, makes sense and quite exciting. One thing to reflect on from what you just said is that, you know, in a sense, you kind of assume the risk because you're waiting for, you know, the person that receives the goods rather to be able to pay eventually. So how does that look like, knowing that, you know, the Rwandan market and most African markets have information asymmetries? You know, the person that has taken the goods probably has much more knowledge of, you know, their products and rather the ability to pay. So there's that kind of information asymmetry. So how does the due diligence process look like for you, and how has that impacted your product?
Mhm. So yeah, obviously there is risk involved. There's a financial transaction. There's always risk, which is part of what we take the payment for, because we assume that there will be losses as well, and we have to cover that as part of our cost. On the other hand, of course, we also don't take just anybody. We will make an assessment in terms of saying what's the likelihood of this payment actually coming. Not only will it come, but will it delay even further than what we deem acceptable. So maybe someone might pay after a year, but we don't think that's an acceptable risk. That's too long, even for us, right? But we'll do standard checks that you see across the financial sectors, things like what we call KYC, know your customer, registration papers, history, background checks from the Credit Reference Bureau, checking if they have any other loans that they haven't serviced, or if they're in trouble with any other financial institution. Then we also have a look at what's the strength of the relationship between these two companies. As in the example I used before, saying with Soros, one of our clients is a supplier to Soros. It's a vehicle mechanic that fixes cars that are covered by Soros vehicle insurance, and they've been working together for 15 years. Right, so we have a long history here of seeing how often do they work together, what kind of invoices do we see, how quickly do they normally pay, and therefore we can really go in and of course, using technology, using modern data science as well, we can go in and put a probability on the risk event of the next invoice. And we will also know very quickly if something doesn't look normal, because someone might pay after 3 weeks normally, someone might pay after 3 months normally. So at the time itself is not only what matters, it's also sort of looking at the specific history that this invoice sits within, and seeing what's normal for this buyer and the seller. But then I should also just say that we do what's called factoring with recourse, so that if at the end of the day the buyer fails to pay completely, the liability falls back on the seller. So we don't offer credit protection in the sense that a debt collector might, and that also weeds out some of the worst risk, because when the supplier knows that we're buying them time, we're not buying them credit protection, then they're also a bit more hesitant of what invoices they will try to give to us.
Okay, that makes sense. So I would imagine that one of the experiences you faced while you're starting out is you notice a lot of this data is siloed and it's all over. It's very difficult to gate. What steps have you taken to be able to move forward with your business?
Yeah, absolutely. And data is one of the unique challenges of any emerging market context. I mean, it's not obviously something we hear spoken a lot about in the African context, but it's the same across most emerging markets. So Latin America, India, Asia, we see the same kind of challenges. We have to be creative, right? We have to sort of use a lot of indirect indicators. And then we also have to sort of realize, well, there is actually a lot of data that we can use. It's just maybe not so readily available as we would like to have it, and we have to invest a bit more in actually getting the data out. So the fundamental question that we're often looking at is creditworthiness, right? So what's the risk on this particular transaction that we're trying to do? How much can we actually know? And of course, I think here's also important to understand the difference between risk and uncertainty. So in a financial sector, we talk about risk, but and as distinct from uncertainty, in that uncertainty is something we just don't know anything about. It can be good, it can be bad, but we don't know, right? So, and as a financier, I hate uncertainty. It's the worst thing, because if there's a risk, there's a price on it. Then there's a probability. Then I can calculate, is it a 1 in 3 chance, a 1 in 5 chance, whatever. As long as I know, then I can put a price on it, and I can say, well, in order for me to take this risk, which I can calculate, then I need 20% per year, or I need 30%, or depending. I can price it accordingly, and then say, well, if I expect 20% of my invoices to be losses, I can build that into the pricing of the product, and therefore sort of have a suitable business. Uncertainty, on the other hand, it could be I lose 1%, it could be I lose 50%, right? And we just don't know. So getting from uncertainty to risk is one of the as you mentioned, sort of that's the key part of any financial business. So there's many different ways of gathering data. I mean, of course, we look at sort of various company registration papers. That's always a good place to start. Who are the people that we're working with? How much can we gather about these people? Do they have a credit record? If they have a credit record, with whom? What was the experience? So what has been the past behavior of these of the company and the past behavior of the shareholders and the managing directors of this company? So really looking at have they paid their loans on time? If they had a postpaid MTN card, have they paid that on time? Like then we also go out and we ask around, you know, people will know something. A good trick that we found to be very useful is you know, if there's a client that we're not quite sure about, whether if we can't find a lot of information, sort of using like the credit reference bureau, for instance, well, then we will go and see where their office is. I mean, we always do a field verification, but if it's someone that we want to ask a little bit more information about, then we start gathering data there, in the sense of how much does the landlord know about them? Have they been renting an office from them for 6 months or 5 years? That's a very different company, right? How much does the MTN guide on the corner know about how frequent the client enters and leaves his office? That's data. It's more time consuming to collect data in this way, and what we're investing the most in right now is trying to automate all that, to gather as much of this sort of what we in technology we call this unstructured data, to make it structured so we can actually use it in our analysis. So the fact that we have an MTN guy on every corner saying that yeah, I see this guy every morning, he's in his office at 8:30. How can we structure that kind of data so that it's available in our risk assessment? But then also we're looking at with the client's permission, of course, gathering data from many other parts of society that we might not necessarily consider. We're looking at tax records, for instance. That can be something that tells us a lot about the riskiness of a client. Phone records, how, especially if we're dealing with a supplier selling to a larger company.
Yeah, please go ahead.
Sorry, I was saying if we're selling to it's a smaller company selling to a buyer, then how often do they call each other? Do we have any you know, can the phone record support that they're actually suppliers here? Because if you're selling someone, surely you must have communicated with whoever is buying your goods or services. So that's also, you know, data that we can use and that we have to use, because the sort of more straight up ways of getting data on risk in a context like Rwanda can be tricky.
Okay, seems a very comprehensive and thoughtful process. I would imagine that you spend quite a lot of time, you know, thinking through how you can make it happen. The other thing that I was thinking about as you know, went on and on about this was, you know, mitigation of risk. How you've tried to mitigate this? Do you think the stock markets, or, you know, thinking of alternative ways such as securitization of receivables, is that something you've thought about? And how soon is it for, you know, Rwandan and African markets? How soon is it for them to be able to make it viable, you know, for your kind of business? Is it an option?
We would love to. For us as a company, I mean, this would be a great growth path for us to be able to securitize our assets. So for just to make sure that everyone is on the same page as us, securitization is essentially saying that all those assets, all those invoices that we're now sitting on, we could sell that on to another investor with even deeper pockets than we have. And there's ways we can structure that so that we spread the risk more thinly, which benefits everyone. The problem is that there's a lot of there's a lot of regulation that needs to go into that. There's a lot of and it touches on a lot of different areas of regulation. I mean, here we're talking about, of course, financial regulation. We're talking about financial oversight. We're talking about the regulatory capacity of the various institutions. How familiar are they with the process? Because they would need to approve every single issue. Do we have the adequate tax regulations in place? We looked at it last year and found that there were just so many gaps in the tax regulation in particular that just meant that it would not be feasible in the short term. Now I know that the Capital Market Authority and Rwanda Finance Limited are working on reforming a lot of these issues, and sort of they are aware of the research that was done last year and the list of reforms that need to be pushed through, but there are comprehensive reforms, and making any changes to tax regulation is not easy. So I anticipated taking some time still before we would be able to do it. What we in the meantime have been looking at is partnering with crowdfunding platforms, because this is an area where we see the regulation is a lot simpler, in that we will not be offering assets directly to investors, but rather going through another licensed platform. So the crowdfunding platform in that sense will be taking care of that on their side. So that we're able to do with a crowdfunding platform in Europe, and we're looking to set up that partnership.
Okay, that definitely makes sense. And so how would you, assuming, let's assume a perfect world where, the securities laws were good, they were perfect, and the tax laws were enabling. In your opinion, how can a startup prepare to handle the reputational and credit risk that would be involved, if say investors, bought in a securitized, arrangement?
That's a good question. I think a lot of people underestimate how much work it actually takes to just to have your house in order, because part of the securitization process is a very in-depth, very invasive audit. Lots of data need to be provided. There will be an independent verification of all of your data. And so this is what I was alluding to before, saying that the regulatory authority will have to approve every single issue, and part of what they do is approve or sort of go through this audit that's being done. And inevitably, an audit will find room for improvement. That's sort of just the nature of running a business, especially running a startup. There is always room for improvement. But I think the best thing one can do is just approach it in a very methodological way, in very structured manner, in terms of saying, well, where can I learn? Who can I speak to? Get their feedback. Get as many people as possible to review what you have already. Do you already have the operations in place? Is there a way that you can pretend that you have the operations in place, that you have the structure in place already, so that you can set up the operations around it, get to work it out, try it out, do the training of your people that you need to do? Because that's the approach that we took. Even though we've not actually securitized anything, we have a relationship with the commercial bank in Rwanda, and we treat that as though it is a securitization. So we've built out the data structure around it, the verification points, the operation points, the approval steps along the way, so that as and when we are ready to go to, so that when the regulatory environment is ready, when we do get this partnership up and running with the crowdfunding platform, the team has already practiced a lot, because it is quite invasive and it is quite taxing on a small institution to be able to manage this. It's a lot of Excel spreadsheets, and it's a lot of attention to detail. So the earlier you can start building out the operational procedures, the internal audits that you need to have in place, the better.
Well, I think we will try to shift to the more, ecosystem related questions. But before we jump into that, I was curious, where do you think there's room for growth? In all that we just talked about, in terms of what could be the emerging trends that, these companies could consider, in financing, alternative trends beyond the more traditional ones that we're used to. What could be the different products that they could consider to finance their operations? in your case, I guess you're giving working capital, and that's something that is adequately needed for them to be able to pull off the operations. For you, where do you see the trends?
That's a good question. I think so, and this sort of relates to what you were saying at the top in terms of saying that taking venture capital comes with a set of requirements in terms of growth, grow or die. There is that expectation of rapid expansion of operations if you're taking venture capital, which sort of also pushes people or should push entrepreneurs into thinking, is the venture capital right for me?
Yeah.
Because it's not right for everybody. In fact, there are a lot of businesses for whom venture capital is not the right funding mechanism, just because it's not the kind of business that's expected to grow 10x over 5 to 7 years, which is the expectation of most venture capital. Now, I would also say that maybe venture capital is also not the best instrument for emerging markets, where things do tend to take longer. When we compare to sort of the more established markets such as US, Silicon Valley, of course, but also Israel, London, these HubSpots of entrepreneurship, these are very well-established markets, and there you can build a great company in 3 to 5 years and exit it for large amounts of money. It just takes longer if you also have to battle with power cuts and corrupt officials and trouble getting your stuff imported, and you can't get supplies, and all the kind of things that we know plague entrepreneurs in emerging markets. So from that, I mean, the first question, of course, always has to be, well, what do we actually need to grow? What kind of company are we? Where are our pain points, and how can finance alleviate that? But also take every sort of every lack of finance as an opportunity to improve, to be more efficient. There is something to be said about working under restrictions, so that you are forced to really be the best you can be as scrappy as possible, and not waste anything, be as efficient as you can. Because if you have unlimited resources, you might not have the discipline, you might not need to. So with that, the trends that we're seeing, there's definitely more angel investment now. So these are more private individuals who are putting in some capital for a share. It's not as aggressive as venture capital. In a lot of ways, it can also come with a social mission. So either to support the founder, or because the business is in a sector that this angel feels strongly about. I've seen in the last 3 years since we started, I've seen a lot of angels arriving in the scene. Some do debt, some do equity investment. One of the trends that I think is particularly interesting is a couple of new entrants in the market that we've seen, modeled on Silicon Valley's ClearBank, which is essentially doing a revenue share. So this is a kind of structure where you take a loan which is paid back as a certain percentage of the revenue. And that is something that I think has a lot of potential in places like Rwanda as well, where we see that if you grow faster, you make more money than you anticipated, well, then you pay back the loan faster. If for some reason sales are slow, you have a bad month, well, then you pay back less, because it's a certain percentage. It's not a fixed amount, which is what you'll see from a commercial bank. So that inbuilt flexibility is something that I think we'll see more of, sort of a growing appreciation that entrepreneurship in a place like Rwanda is just unpredictable. It can be quite volatile, and therefore whatever financing mechanism needs to have inbuilt flexibility in it. I think the model that we're seeing sort of historically has been the commercial banking model of a set term loan, 5 years, you pay the same amount every month regardless of how your business is doing. That's probably on the way out, and giving way to more flexible agreements, where there's revenue share, whether it's venture debt, whether it's can also be a blended version where it's part equity, part loan, equity buybacks set up. There's many different ways. It's nowhere near as developed the sector as I think Rwanda needs and deserves. So that's definitely an area that I hope will continue to see more growth in, new players entering the market, and sort of continue to offer more of what Rwandan entrepreneurs actually need.
Okay. The other thing on the ecosystem generally is if you're, getting involved in, these kinds of alternative financing transactions, or, financing your company differently, thinking through factoring, obviously it's a very knowledge heavy kind of structure. So how has it been for you being able to attract, investors that understand this, that, are interested in working with you? And then, of course, even after they've understood it, you can tell that there will be an appreciation of risk. There's a bit of risk that is involved for them. So how have you been able to get investors that are very accepting and, they welcome what you do?
Well, I think that the best advice that I ever got on this was to remember that investors are more, rather than being scared of losing money, what they're actually most afraid of is missing the big opportunity. Because most investors, especially those that invest in young companies, they accept that some of the companies they support will die. Same as we build into our model that some of the invoices that we finance will be lost. Of course, we try to keep it at a minimum, but every bank has some loss. Every financial institution has some loss. So it's the same for an investor. But what they're more afraid of is that there is now a new Jumia, there's a new M-Pesa or something coming out of East Africa that they're not part of. That, and once you keep that in mind, it's much easier to sort of twist the conversation in a way where it's not only, you're not asking them for money, you're giving them an opportunity. Right? You are the one who will create a grand company. You will be successful. You know that. They can either join you or they can forever hold their peace, right? But now is their moment. That's sort of the dynamics you want to have in a conversation. Of course, they will ask questions, and of course, you need to be able to back it up. But I think if you come from the conversation with that, into the conversation with that confidence that you are actually doing them a favor by giving them the opportunity to invest in you, rather than coming there with the hat in your hand and asking for money and asking for a favor, you're not going to get very far with that. You want to create that what we call the FOMO, the fear of missing out, because that's the thing that most investors fear the most.
Okay. And for you as a company, of course, I would think that making a return for any potential investors that would be in this kind of space is something that keeps you awake at night. So for you, how do you think, on two angles, how would alternative financing be leveraged to create an exit for the investor? And then you're living that kind of dream as a startup, you've built your company around this. How would you, promise an exit for the investor?
Well, it's something we're still figuring out. I don't say we have all the answers to that right now. We're still very much growing. We're still very much developing the company. 2020 has been hard for everyone, both investors and entrepreneurs and everyone in between, in terms of what has happened with COVID-19 and the disruption that we've all seen to our lives. So I think what we've seen, a lot of the conversations we've had with our investors and potential investors in the last 6 months, well, since March really, has been more around how do we survive, how do we maintain, and how do we invest in our stability, in our resilience, so that we may come out of this crisis stronger, and then we can get back to thinking about growth on the other side. But first, consolidate what we have, make sure we don't die in the process, because a lot of companies will die. A lot of investors will see their portfolio shrink as companies close. I mean, imagine you've just invested in a young startup in the travel and tourism industry.
Yep.
Tough luck, right? So investors will see losses as part of this. Things will change. Who would have known that we would all be on Zooms 6 months ago? I wish I'd invested in Zoom back then, right? But so in that sense, the conversation, of course, is always influenced by what's going on around us. For us, alternative financing is something we're looking at a lot, and it's something we want to be part of shaping as well. So I'm constantly looking out for what other players are in the market, what are other companies doing. There's a number of companies that I'm watching that are sort of a bit ahead of us in terms of the maturity and the growth stage that they're at, and I'm trying the best I can to learn from these. I've a very strong network of fellow entrepreneurs in East Africa, and sort of seeing what other bright ideas these guys can come up with that I can also use and leverage. We're seeing a lot of corporates entering the acquisition space. We're seeing a lot of various business groups in one way or another trying to buy up younger, especially tech startups, like logistics, tech, and so on, being bought up. So that at the moment seems like the most likely route to exit for investors on the African continent in particular. We haven't seen that many IPOs.
Yeah.
They're there and they're growing, but that's of course less common in this context. So for us as well, we're also looking at acquisition as the most likely exit. And then we're thinking about, well, who could potentially be interested in buying us and at what point? And then we kind of work back from there. So is it a banking group that would be considered interested in buying out a small company like us? Is it a strategic investor? Is it a trade group that wants to grow sort of, it could be a logistics provider that wants to add factoring to their offerings? And then we sort of look at, well, how can we then position ourselves and add a portfolio that has interest for such a potential acquirer, and try to build that. But it's I think it's something that we intentionally want to keep open, because we don't know what the future holds. I mean, COVID is a good example of you can't lock yourself into too tightly. So maintaining the flexibility, keeping in mind that it's something that we're interested in further down the line, and then just building as much as we can in the best time. And then if you build something of value, I'm also quite convinced that one day there will be people interested in buying that.
Yep, I agree. And it being Africa, it being Rwanda, we are all unlearning and relearning, a lot of things, because as you said yourself, the traditional way of doing things, of financing or even exiting, are, being disrupted because it's a market with a lot of challenges. Our time is fast spent. I thought we would take off some time and hear from our guests today. So Sam had actually asked a few questions in the form that they filled in. So I will start with the questions that I see on the forms, and then I'll give people a chance to, unmute their microphone and ask a question. I think we'll limit the questions to about 5 in total, because we think this should be at least an hour tops, and then we can all go off. So one of the questions that I'm seeing here is, there's a graduate assistant from Strathmore University that asked a question that, what do we mean by alternative finance? And then they go ahead and ask, rather, alternative to what?
Yes, that's an excellent question. Right, so in finance, we often talk about traditional versus alternative. And broadly speaking, people will debate the definitions, but broadly speaking, traditional finance is a bank giving a loan. So alternative finance is everything except that. And it can be things that are technology intermediated, it can be community based, it can be crowdfunding based, all of these, any type of financial instrument that doesn't involve going to a bank, pledging your house as collateral, and then getting a 5-year loan where you pay the same amount every month, is what we will broadly consider as alternative finance.
Okay, thank you. And then there's another gentleman. There's someone from, I think it is Nazami and Company Advocates. No, sorry, BKA Advocates. They ask, they would like to know how technology can facilitate financial inclusion. And maybe let me just also use that chance to point out, how could technology be a part of this, process to improve it?
Yeah. I think it really comes back to sort of thinking about, what, on the one hand, what is technology and what is it that a financial institution is doing, right? As I mentioned in earlier, a financial institution is doing everything we can to go from uncertainty to risk.
Yeah.
So what are the tools that I can use to go from uncertainty to risk? Technology is one of them.